Ladies, gentlemen, all 10 of you, welcome to Value After Hours. This is one of your hosts, Bill Brewster, with my co-hosts Toby Carlisle and Jake Taylor. Jake, what are you going to be talking about this week?
I'm going to be discussing the Prudential Algebra of Ben Franklin that might help you improve your investment process.
Toby, what are you going to talk about?
The first decade of the 2000s was expensive names with surging fundamentals and flat stock prices, where value did very well. Second decade was the reverse. Surging fundamentals led to surging stock prices and value stayed flat. I'm wondering what happens over the next decade.
All right, and I'll be talking about the joy of owning financials and travel companies right now. It's the best. Right after this.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, he will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
Yeah, so this week we're going to do a big therapy session because markets are off 12. They're off 15.5 at one stage, which was getting pretty gnarly. We still haven't gone. We've gone through 2016. We're a bigger drawdown than 2016 at the bottom. Not as big a drawdown as 2018 yet, which was 20%, like a golf ball off a concrete path and back to new all-time highs. I think yesterday we saw
bitterly.
Well, yeah, I wasn't long. I mean, I was long, but I wasn't. I had a whole lot of shorts that got shredded in that. And then yesterday we had that monster 5% rip, which I think is probably arguably still kind of bear market type behavior. You get the big volatility, rips and moves. But what's happening, Bill? What are you seeing?
I didn't see a 5% rip yesterday. I guess that's because I was looking at my own portfolio.
It happened all the way at the end of the day. It was at the close. It was looking shaky for a little while.
Oh, that's weird because I looked at 5 p.m. and I still didn't see it. I guess maybe there was a glitch on my screen.
Were you at least green yesterday?
Yeah, I think I was.
That's how you know you're a prepper, if you were red yesterday.
Yeah, that's a good point. I mean, look, I guess that, so I have talked about airlines. I don't really want to go down as the airline guy. That's not like the bet that I'm trying to make. But, I have been buying into this weakness a little bit. As I have learned many times in life, Buffett beat me a little bit on the price and, quite a bit on his cost base. Oh, yeah. I mean, he also yesterday bought, and now people feel like it's okay to buy Delta. Let's see how they feel in 4 days. I mean, I tweeted out after the investor day, like, it had a good day. I said, welcome to the pain train. Like, these things are not easy to own. I mean, fundamentally, I do not expect to be with the market right now because I am deploying some capital into travel-related entities. So the notion that I would keep up right now is sort of silly.
When you say travel-related, what's your definition of travel? Airlines, so Delta is one. What else?
Yeah, I mean, I own Ryanair. Some Booking Holdings is one that I've been buying.
OTAs.
Yeah, one OTA.
What's an OTA?
Online travel. Yeah. But like, I don't like Expedia or TripAdvisor like I like Booking. And then, like, I've been looking at Eldorado a little bit, ERI. I haven't done anything with that, but I hear that they're great operators. I've heard that from a couple people. So it's something that I have on my radar. So, like, my thesis is this is where the pain is. Something that is difficult about owning pain when pain occurs is, like, if you're long airlines, in my opinion, you need to own this to deserve the return. And if you're going to get scared at this, you're not owed the return that the business is going to deliver. Because by definition. Now, the other side of that is I'm seeing how people are reacting to the coronavirus. And what I'm about to say, I'm not trying to offend anyone, and I'll probably piss off everyone. But, like I'm looking at the South Korean data because people say it's the most reliable. And it appears to me to be sort of flu-like, and a 0.6% death rate doesn't seem to be like the craziest thing in the world. But I went to Target the other day. There is no toilet paper. There is no Advil. There is no nothing. And I mean, like, you look at these pictures of airports, things have just stopped. Conferences are getting canceled. And I just think of the knock-on effects of what that means. I mean, McCormick Place is going to sit vacant for a lot longer than it ever has in recent history down here. I mean, you got restaurants, hotel rooms, cab drivers. Like, we're about to incur a lot of economic pain running from something that I'm not sure we need to run from. But I'd say that as somebody that's uninformed. But anyway, that's what's going on in my life.
Are you sure that wasn't a Sears that you went into and not a Target?
Dude, it was crazy. It was really nuts. I mean, I had a woman in front of me. I think she's trying to wholesale toilet paper. Like, lady, I don't know how long do you think you're going to be locked down, and how much do you shit? Like, I mean,
is toilet paper on top of your priority list when you're prepping?
It is on hers.
It's huge, yeah.
Yeah.
Have you had the flu?
Yeah, but
and I want the right kind. I do want the right kind.
I've never had the flu. No.
Yeah.
I was sent to get like a specific type, and then I brought back not that type.
Oh, first world problems here.
Well, and she was like, why didn't you get the type? I said, look at this picture. There was none. Everyone likes your toilet paper.
You got that scratchy ass 1-ply particle board.
I got 2-ply. I'm not an amateur.
So here's the question: what's the impact to the economy? There's whatever happens. This is the. I think that this is pretty. Putting aside all of the deaths, like in the quiet words of Bill Bird, 2% of you people have got to go. So I think that that's what we can deduce from everybody's take on this. There's a lot of people that's gonna die. Basically, we hope that it's not us, and it's going to be, stimulative for the economy is what I can take from most economists at this point. So all of this buying is going to front-end load Q1. And then,
so broken window logic there. I can't.
Yeah. So my real thoughts are, I think that Emmanuel Derman had a great tweet today where he said something like, "Worry about the people first, and the economy will sort itself out." And I do think that that's the right approach.
Yeah, for sure.
When the WHO is commenting on the market, I don't really want their take on the stock market. I want them fixing the problem. But that whatever happens, it's not going to turn up until we report in. The Q1 reporting doesn't come out until Q2. Q1's almost over. So the real impact, I think, is in Q2, which doesn't come out until midway through Q3. So I think this is something that's with us rolling all year long in a very 100%. Expensive market where the Fed's already cut 50 bips emergency today. So I didn't know that the Fed had the cure for the Wu flu. So I'm psyched to hear that they do.
And the market puked the Fed cut, right? So... Yeah. I mean, to your point, I thought we were dealing with a virus situation. Maybe the tax cuts will help the virus and not the Fed cut.
Well, the WHO is watching the stock market, and the Fed's got the fix for the Wu flu. So maybe we need to switch those organizations around.
I want to be really careful so that people don't think we're like taking this lightly, right? I don't want people to think that like this is just we're just having fun with this. But the fact is, like, that really, I just don't know. You're running from a boogeyman in the argument, because the argument is this is going to shut down everything, and the world is gonna, needs to come to a stop so we can prevent this disease. But the only data that I've seen show that like it really isn't that much worse than the flu. And I could be an ignoramus. I mean, I'm open to that possibility. But to your point, like, I mean, we're gonna cancel conference season. We're going to cancel, like, March Madness is going to get played without people in the stands. Well, yeah, I guess Japan came out and said they're not going to do that.
Yet.
But, that's right.
Exactly.
I mean, I don't know. Is everything going to come to a halt? I have no idea. I don't think that you can be an equity investor and puke out this fear and then try to buy back when the fear recedes and expect that you're going to, like, earn the return that equities deliver. That fundamentally, I think, is a losing strategy. But I underestimated people's reaction to this news.
I mean, this really is one of the ultimate kind of tests of what is your time horizon, right? Because there are probably tape bombs coming for you in everything that you own, and the pain is probably coming. But if you're more than a 5 to 10 year investor, then it's probably not the end of the world. But if you're shorter term than that, like there is probably definitely quotational pain coming your way. And if you know it's coming, do you sell now? I don't know. This is totally like, this gets back to like, what's your philosophy as an investor? This is like, principles are easy to have when times are good. It's when they're tough that they matter, right?
Yeah, that's right.
Like John Maynard Keynes, I update my view as more information comes in. I don't mean anybody to interpret what I'm doing as taking this lightly. I think the whole situation is completely ridiculous. I think it could be an incredibly lethal virus, but I think that it's ridiculous the way the Fed responds to it, the WHO responds to it, the government responds to it. I don't think that any of it helps any of us at all. I think you're on your own, so wash your hands.
And pardon me if I don't get a little bit like less trusting if everyone's looking at the stock market. Like, let me do that. You guys worry about the health, right? Like, geez, what is going on here? So I don't know. It's crazy. I mean, I don't know if you saw Schwab, but after that cut, they were off 8%. All the banks got hammered. Berkshire got hammered. I mean, at some point, like, what are we doing to our financial system here? And who are we doing it for? And what the hell is basically what I can sum up the cuts.
We're doing it for Robin Hood, the Robin Hood traders who can't access their account.
Yeah, well, YOLO to them.
In memoriam, Vale.
Yeah, and look, I'm not trying to be somebody that's like bitching. I mean, I'm long cable. That's going to help me there and whatever. But
because everybody's going to be at home watching TV.
Well, no, they're also levered now. You can just, if rates keep going down, you just roll your debt. But I just don't understand what we're all trying to accomplish here. And what
does it mean that there's a rate cut, 50 bips, pretty material given where we are, and the market pukes pretty seriously? What's that indicate?
I don't think it's a good thing. I mean, I think that if you want to put your tinfoil hat on, you say that the market's
do that.
lost. Yeah, like the market's lost faith in the Fed.
That's a disaster for them if that's the case.
Yeah, well, I mean, this is what the Austrian school has been waiting and waiting and waiting for years, right?
Every Austrian right now.
What do you think? What do you think about Powell coughing during the presser? Was that just was that like 3D chess to throw everybody off the scent?
I don't know.
God,
that Jim Grant's spraying the champagne right now. No, I shouldn't say that, Jim. I'm sorry. I know you listen. One of the 10. But yeah, I don't know. I can't. Everyone is worried. The thing that is confounding to me, and I guess when the 10-year goes down like this, you got to keep the curve somewhat upslope to the extent you can. But this is a demand shock. Like, and it's not a demand shock because there's not enough credit. This is a people's willingness to buy issue. And like tax cuts don't fix that. Rate cuts don't fix that shit. Instilling confidence in the people that the virus is contained and that they're going to be okay. That's what fixes this. Shutting down every event and cutting the Fed cut like seems to induce panic to me more than anything.
Is the sell-off caused by Wu flu, or do you think it's got some deeper issue?
I mean, it was so damn high to begin with. Like, how many more? Like, you didn't need a whole lot for people to say, like, well, is this really worth that much at this point? Maybe not. I mean, things have been going along so rosy for so long, and just nothing mattered, right? It felt like nothing mattered for the last 5 years.
That nothing could stop it.
Nothing could stop it. But maybe finally this matters, and people are like, well, we had a good run. Let me take my wins before and get them out of the casino before everyone else decides they want to leave this party.
Yeah, well, I think if travel is any indication, time horizons are getting shorter. So if it'll be interesting to see I read that like Estee Lauder, a lot of their sales come through duty free at airports now, and like that has no traffic. Are Estee Lauder shareholders going to be as long duration if this thing continues for 6 months? I don't know. I mean,
the second and third order effects of all of this are kind of mind boggling, really. Like, I don't think anyone really knows what could fully happen.
Yeah, and like, look, this thing, if it's a 3-month disruption, economically, it doesn't matter, and if we're all healthy, that's great. Like, whatever. If people maintain this level of concern, I mean, they say it's going to come back next fall. So if this is like a 12-month issue, I have questions on how strong the system is with all this leverage on it. I'm not sure that it doesn't become a really big deal.
Let me ask you this, as far as like, what is the Fed trying to accomplish other than just to kind of make everyone feel better with lower rates? But like, who in the corporate world, who governments, who on earth has not been able to borrow enough money at this point? Is that really been the problem? Is they couldn't get access to liquidity? Like, that doesn't help anything, adding more.
Yeah, I mean, I think they're just trying to keep the curve somewhat flat to upsloping. And I mean, the 10-year right now is just, I mean, what I saw today, it's like almost at 1%.
Remember the inversion?
Like 1.08?
Remember the curve inverted? That's preceded every single sell-off in the market.
And then we got uninverted, which Gunlock said is what normally happens. And now we've reinverted, right, for a second? Yeah, you're like Tom Cruise. That's
we were
right.
Inverted.
We were inverted.
Keeping up foreign relations.
So you're the one.
Giving him the bird.
That's right. So yeah, I don't know. It can't be good.
So I got a topic. Going to throw this out there. Probably going to get a lot of hate mail for this one, but this is what I think, so I'm going to say it anyway. First 10 years of my career, like roughly early 2000 to 2010, very expensive but good stocks were flat for that whole decade, even though the underlying fundamentals of them were surging. And so there were a lot of stuff like, GE is an example. There were a lot of companies that were lionized in the late 1990s because they could beat by a penny. They were very strong. They rode it all the way up to the top and then just treaded water for a decade. As even though the fundamentals continue to be very strong, I've seen that analysis done of Microsoft. Microsoft did very well for the most part through the next decade. Last decade, those companies have once again, the stock prices have done very well, even though the fundamentals have been largely the same. And value stocks, which did very well in the first decade, even though they're kind of junkier companies, they're not as good. Fundamentals are a bit rougher. Have not done as well this decade. There's been that price compression in them to the point now where I put this out on Twitter yesterday. The Fama French of Fama French has a data website where you can pull up different return streams. It's all free. You can just pull down a CSV file and you can go to town on it, do whatever you want with it. So I pulled down price to cash flow because I think that's a pretty good proxy for the way that a lot of guys invest. I know enterprise value to cash flow would be better, but we've got to work with what we've got. It shows that the cheapest decile, the cheapest portfolio, the value portfolio, is now yielding more than its long-run average. And the only two times that's happened in recent memory was 1998 to 2000 and 2009 at the bottom, and both times value went on a very good run straight afterwards. So I just wonder if we're about to go into another decade where extremely expensive stocks are going to trade flat for a decade, even though the fundamentals continue to be quite strong. Value stocks, even though the fundamentals are pretty rough, I think they're going to have a better run on an absolute basis, but certainly on a relative basis.
Yeah, I would love to know what the debt looks like on that portion of the cheapest 10% versus the cheapest 10% in the other time frames where it did well. Because my anecdotal, just like digging through the garbage bin like I do, has been a lot more leverage that makes me uncomfortable compared to previous
almost certainly
garbage
up, right?
banning. So
almost certainly up,
which makes the game a little harder. There's probably just more zeros baked into there. So I don't know. Will you get the same outcome? Maybe, but it might be a little bit different this time than it was in those other times. I don't know.
Yeah, those are the two thoughts that I had. How much leverage is on top of the equity, and then how cyclical are the underlying earnings, right? I mean, that's how you capture the both parts, right? And then the question is, well, was it any different back then? I don't know. I think that one way one way that you could probably mitigate that is repurchases. Now, some cynic would say, well, share repurchases are pro-cyclical, so that's not going to do anything for a cyclical business. But, I don't know.
You guys don't buy my golden age of value thesis? New golden age for value.
I would love to if that was the case. I mean, there's no one rooting for that more than the three people sitting on this podcast right now. Yeah. However, I just am a little nervous about if actually we have apples to apples here.
That's because you got Stockholm syndrome. You've been brutalized for a decade.
Yeah.
I just think it's going to be really hard for. I mean, the game is hard. It's going to be hard in the future, and there's some names that.
Well, what do you do then?
Stretched.
What do you do? Go by name? Is that what you're saying?
Yeah, well, look, I mean, the way that I know how to approach it is I'm buying booking. It's not financial advice. Don't do it if you don't know what the hell they do. But, I think it's a good business.
Books, right?
Yeah, that's right.
Okay.
I think it's a good business. I think they've demonstrated their ability to survive with Google flexing on them a little bit. You've got a secular grower at an average multiple. So, that's how I try to invest.
Can I just say hats off to whichever advertising agency came up with that booking, it's booking excellent or booking great, booking.com. Yeah. That's one of the best ads I've seen in a long time. Unforgettable.
Hey, Bill,
Priceline was pretty good too, actually.
Yeah. Are you a secular grower or a secular shower?
I'm more of a neither. I'm more of a turtle. Anyway.
It's cold in Chicago.
That's right. That's exactly right.
So I got a little somebody shot a note on Twitter about I think I said that Berkshire was better than average, and I might have quoted return on invested capital, and I still think that that's the case in terms of their holdings. But and I said I think it's better companies, probably evidenced by better return on invested capital, available at less than a market multiple. So that seems to me like a pretty safe bet. And someone said, that's not what you buy. What you buy is the whole thing. And if you include all of the other, the float and all of the companies that they hold, you're not getting that. You're not getting. It doesn't matter that the return on invested capital is better. What do you guys think about that? How do you value Berkshire?
I try to do a sum of the parts when I do it. I don't disagree that the return on invested capital may be better in other companies. Like, it may be below average. I haven't looked where it is.
Once you back out the float and the companies it holds.
I don't think you can back out the float. I mean, I view that as like working capital for them. But, dude, you have the best utility in the entire United States. Like, that, sure, it's not a strong return on invested. Yeah, well, I mean, look, that's the stuff that, like, you make money over the really long term. That's a durable stream of cash. Like, that's, and in a rate where the 10-year, or in a world where the 10-year just went to 1, like, what's that worth? And when you can fund some of your CapEx with some insurance float, to me, that's an above average business. Now, if the returns on invested capital are lower, I can understand why somebody may not want to pay as much as maybe I am willing to pay for the certainty of what's here today. But I think my return stream in Berkshire is tighter than the average company, even if the return on invested capital is somewhat less optimal, if that makes any sense.
What do you mean by tighter?
I don't think that
More likely.
So there's someone out here that's going to laugh at this and be like, this guy's going to get destroyed by when Buffett dies and it's all a fraud and it's the next GE. So I apologize for being...
Doesn't have as much debt. Debt's
yeah, well, I think that there were a lot of things that happened, and I have liked that in the past, so I'm just not going to go back there. But
rest in peace, Jack Welch.
Yeah. I guess that what I would say is I don't think that your downside in Berkshire is as far down as your potential downside. I think that business is very, very durable. And I'm not sure that you're entitled to a superior return than the average business in good times, but I definitely think you're probably a lot more likely to avoid landmines in the down times. And over time, I think that works.
Well, it's an interesting thought experiment in that let's say that you could take company A that has 40% returns on capital, but by definition, almost that is bringing in the competition that will make those shorter lived returns on capital. Or company B, who maybe flies under the radar a little bit with a 10% return that's not really attracting a lot of attention and doesn't then also attract competition, and you put up 10% for 30 years straight, that's going to be a bigger number than the high flying 40 for even 10 years that then decays and is low for the remainder. So if you're on a really long duration type of investment, there's an argument to be made that you almost want the returns on capital not to be outrageously high. You almost want them to be like stealth returns on capital.
What level flies below the radar? That is, what's the best you can get below the radar? Like 13 and a half, 14? Guys screening
probably
at 15?
Right wherever Berkshire is. I don't know.
But like you ask anybody, where do you screen 15% return on invested capital? That I want the 14.5%.
Yeah,
forever and
that's
ever.
Fair. I mean a lot of 15 to 20 is probably where a lot of screening cutoffs would be my guess.
I mean, you can put if you want to pick Berkshire apart, you say, okay, great. So you're long banks. That's fantastic in a world where rates are going down in a nonstop fashion. You're long Coke, which I think is almost objectively rich here. You're long, well, it's definitely not objective, but I think it's rich. Fruit of the Loom, what's that got left in it? Dairy Queen. I get how people can say it's a bunch of tired brands. I think that my bet is that those people are underestimating, A, how good Buffett is at banks. Like, banks have a lower return on capital or assets than most businesses, but you've got the best bank investor in the world picking them. And two, I think culturally, like from what I've seen from Ted and Todd, I think that the future size may be the condition that hurts this, but I'm not very worried about them being able to carry the torch. Like, those guys are really good at what they do.
Just a segue, did you see Terminal Value, account I follow, very funny, had, Jack Welch passed away at 84 and the street estimate was 83.
Yeah, I did like that. That was a
funny
funny joke.
Yeah.
That's solid.
That was a funny joke.
I got a mailbag comment rather than a question, but I thought it was a ripper, so I want to share it. So Mark Leonard has a son. Damien Leonard. And Damien Leonard got control of a company a few years ago to utilize the net operating losses and invest in a tax-efficient manner. He's got this company primarily invest in publicly traded software tech names, but definitely approaches investing with a value mindset. This particular company, it's 65% a book as of 9/30/19, so September last year. Half the portfolio is in cash, waiting for a pullback. That's from Steve Vafier, and the ticker is PNP.TO. It's a Toronto Stock Exchange listed stock. PNP. It's called
Pinewood or something like that.
What did you think when you looked at it?
I just verified that all those numbers were true. That what he said and seemed to be true. It's very, very early on in the story to ascertain if does capital allocation skip a generation or not? We don't know. But
Pine Tree Capital is what it's called. It barely trades, so just take it easy, and it's probably going to get a little rip from.
Is it showing any promise? You don't want to be the guy that passes up Ken Griffey Jr.
Well, the problem is, yeah, good point. I mean, we're talking like a couple $1,000s of volume a day right now. So
I just didn't know if the business was showing any promise.
I think it's an investment company. I think they're kind of half cash looking to buy the publicly listed SaaS names.
Yeah.
Buffett's got some like nephew or something in Boston I think he's doing the same thing with signs, like outdoor
billboards.
Yeah. Boston Omaha is the company.
Yeah, that's right.
And when the article came out about them, I think it was in Wall Street Journal, like that thing ripped.
Yeah.
Everybody wanted to be involved. So if you want to try to play that, this Pine Tree might be a Canadian version of that, but it's not really the game that
I don't have a holding. I'm not talking my book. So if it spikes, it's not benefiting me at least.
But it was because of us. If it does,
yeah, that's right. If it doesn't work, then that was somebody else's fault.
Yeah. I love this kind of optionality.
This is great.
Steve could, he could be pumping it on Twitter. So if it goes down,
this is what it's like to be a newsletter writer. You just get to talk.
Can you front run as a newsletter writer?
I don't think that's right. I think if you disclose, you just got to be. In my opinion, you got to be honest with everybody. You can't pump a name and own it and not tell people. That's not
Your Honor.
Yeah.
But how am I going to know what's the next Amazon that you can't afford to miss out in your portfolio?
That's a good point. And you should, to be fair, you should have to disclose how much weight you have in the portfolio, right? Like you can't be pumping something and not own it for real, I don't think.
Well, I bought the S&P 500, so technically I do own.
There you go.
Yeah. I own everything, and then now you can. All right. Let's change gears. Great. Take off tinfoil hats.
I got the tinfoil undies on.
Oh, good. So my topic was in your investment process, it's very easy to keep digging and digging and digging into a company, and you're adding data points. And a lot of times I'm not sure if you're always adding actually relevant information. And so one of the things that you can do then is to take a page out of Benjamin Franklin's book, which he called Prudential Algebra. And what he did was he'd basically make a pro and con list, and then he would assign weights to the pros and cons so that it wasn't just the sheer amount of data or entries that you put in, but you had to assign some kind of a weight to them. So they do this in advertising too, where like they'll put up a really long list of features. Most of them may not even be relevant to you, but the more features that you even just see, the more good things that you associate with whatever that is. And so our brains are wired to take the number of entries often and not necessarily the weight. So sometimes I think we give ourselves false confidence by the amount of research that we do, and we add to our confidence at a faster clip than we add to our understanding. So another way to do that actually is and this is taking a page out of computer science. It's called regularization. And what happens if you have a model, and in this case, it's really your mental models. You have a model that is like perfectly explains the previous, data. It's called overfitting. You can end up with it explaining perfectly in the back, but then nothing going forward because it's too fine-tuned for the past data. Well, one way of regularizing that is you just take like your top 5 most salient pros and cons and look at those and weigh those against each other rather than trying to have, I've got, a list of 1,000 things I like about it and 200 that I don't. Well, maybe there's a couple in that 200 that are actual deal breakers, but because the numbers don't match up, our brains are not really wired to handle that very well. So that's a little thing that I've been working on adding to my investment process to try to control some of the biases that I know exist.
Yeah, I like that. There's 2 papers on it. One looks at college students handicapping college football, and another one, same theme, professional horse race handicappers handicapping horse races, and they give them, say there's 50 data points, they divide them into 10 groups of 5 data points, and they give each of the college students or the handicappers all of the information eventually, but they get some information first. You're randomized which group of 5 data points you get. So by the end of it, everybody gets the same, but at the start, you get wildly different amounts. And what they find is that people anchor on to their first decision. So the first 5 data points become the most important data points that you get. And then you include or discard each data point that you receive after that based on the initial assessment that you make. So you have to be very careful with that initial assessment. So I think a better way of doing it is either decide on which data points are important to you and then only look at those, or make your decision and then start hunting for disconfirming evidence. And so you're only now looking for things that prove the thesis wrong. But I like that Benjamin Franklin approach. That's the same kind of way of dealing with the issue. That's smart.
So Darwin also did this in a way where he took he made a pro and con list about getting married, and he had written a bunch of things, but he actually regularized it he kept it only to one sheet of paper. So he had to put the most salient things onto that one sheet of paper, which is a kind of way of keeping from overfitting his model.
Was it getting married or getting married to a particular girl?
Period. Just full getting married.
Just getting married.
Yeah. And like, if you find it and read it, it's pretty funny. Like some of the things about horribly boring conversations that you get stuck in because I wouldn't know anything about that, but I'm sure that happens to other people. Thankfully, my wife never listens to this, so it's fine.
I enjoy every moment. I don't know what you talk about. That I think was so smart that I'm going to have to listen to this episode 3 times. I am one of the 10. Yeah, I think that's.
We need T-shirts that say that. I am one of the 10.
We would be the only people that would wear that.
Get your merch all over Berkshire.
Get your merch. Well, it'd be we figured out it's us, Gates, Buffett, my man Ian Castle. Shout out Ian Castle. Corey Hofstein. That's pretty much all we got. That and Bill. And did I say Bill Gates and Jim Grant today? So shout out to everybody. When you were talking, it reminded me of something that Preferred Shares on the Twitter machine had said. And he said that the best investor that he ever had known was the worst financial modeler. And the thing is, the guy was just very, very good at drilling down to what are the 2 or 3 things that matter, and then just researching that. I find it easier said than done, obviously, right? That's probably the dumbest thing I'll ever say on this podcast, but it really is. The airlines, bring them up again, because why not? It's interesting. In the underwriting, when you think about consolidation from my perspective, it's like, okay, well, what happens if 2009 happens again? What happens if 9/11 happens again? A pandemic that shuts down all the travel for an indefinite period of time, that's a hard thing to underwrite. There
are lots of flights being canceled now.
Yeah. Well, one thing that I think will be interesting is the 4 executives, at least the big 4, are going to Washington to sit with some people tomorrow. I would be shocked if some discussions about coordinated capacity reductions don't happen.
It's an interesting perspective, though.
Yeah, if you don't let them do it, they might need a bailout. So you got to figure out when you're going to enforce the law and when you're going to let them actually cheat a little bit. And I think this may actually be a point where you let them cheat a little bit. For the
of course, you would say that being long airlines.
I'm saying it as a taxpayer, dude.
I'm just teasing you.
I do think it's funny that you get these things like this happen in the market, and your attitude to it kind of dictates the sort of investor that you are. If you look at this and you say, I need to get out of everything, then that's one attitude. And another one is this creates an opportunity to get these things pretty cheap. I think that airlines were already pretty cheap. Mm-hmm. I think that something like this, I actually haven't seen a lot. I'm sure that there's a lot of decimation of the portfolio because I have some airlines as well, have an airline at least, and I'm short Expedia with full disclosure, not because I foresaw coronavirus, just because it's got its own problems. But I think that there are there are times like this in the market where I really don't think we've actually, even though we're down 15%, we were at the absolute pinnacle. I think I sort of still think we're in no man's land. Like nothing's really happened. We haven't sold off enough that I'm particularly excited about what's there.
I don't feel like my hand has been forced to I got to buy something here. This is just too stupid cheap.
Well, if you didn't like it in October, you're not going to like it now.
Right.
And it's not like we've come down that much.
October of which year? That's the problem for me.
Yeah. Well, I looked after the big
October
sell-off.
of 2015.
Yeah, well, we were down to January 2018 levels, right? I didn't think that things were run outside with buckets in January of 2018.
No.
So
I do think that we're going to get to that point. I mean, I don't know. I'm not predicting a crash. I'm not doing anything like that. I have been doing this for long enough to know that just whatever you say is going to be max embarrassment. So, but I think that you get to this point where, I remember this in 2008, 2009. There was this point where I just woke up one day and I thought, holy cow, everything is just ridiculously cheap here. And I started buying sub-liquidation value because I thought these things could go to zero and at least you get a little bit of a bailout. Clearly that was not going to happen, and I don't think that's going to happen this time either. But I do think you wake up one day, if the market's down, and you'll be like, holy cow, this is as good as it gets. It's time to really pin the ears back and start buying. But it's not now.
Yeah, the only thing that I would push back that you said clearly that wasn't going to happen. I don't know that it wasn't that, it was not that clear. I think that is easy to say in hindsight, and if people lived it and paid attention at the time, when you would wake up and see bank after bank after bank down 10, 20%. I remember right after Lehman failed, that was crazy. And people were talking that Goldman was going to go under. If Goldman Sachs had gone under.
Well, they switched over to the bank holding company.
I know.
To get the protection.
So I'm saying I'm not so certain it was clear that,
That's banks though. I don't think industrials, if you got an industrial without any debt, I don't think the industrials are going to zero. That was my sort of.
That's fair.
The first time I'd seen the big crash, I didn't have any money. The second time I saw the big crash, I had some money in the market and I'd been cut to pieces. And I thought that there was I didn't know. I think now in retrospect, and if we encounter that again, which I think we will at some stage. I'm not saying now, but at some stage, I don't think we're going to zero. I think things are going to get torn up. There are going to be a lot of landmines, but I don't think that there are going to be. I don't think the whole market goes to zero. I don't think that's ever happened. Even in a 29 style crash, it still functions and still goes on.
Wait for that 100% passive, all wanting to sell at the same time, right?
That's got to create opportunity, though, doesn't it? It's got to create distortions that create opportunities.
But what if all of the people who previously would have been buyers on the way down, that kind of buyer of last resort, have been fired? But
ultimately, I'm a business guy too. I don't mind holding it. If the equity gets cheap enough, I'll buy it as a business guy. If you can lever into it, there's a million ways to get control of these things. You'd do that, wouldn't you?
Oh yeah, for sure. That's is there enough private equity on the sidelines ready to take out some of these public companies that get cheap enough?
There'll be money around.
Yeah, you
can cobble something together and get control of a little. There are guys in the 30s and 40s were doing that. They were the white sharks of Wall Street, cobble together whatever they could get control of these things. If it trades down cheap enough that you can get it for less than the cash that it's got in it, then that's a pretty good buying signal. Whatever happens, there's going to be opportunity. I'm not worried at all. In fact, I think that I would rather see a big sell-off because I think that creates opportunities for guys like us.
I don't know that it's coming. I just don't. I don't know that I think things are that rich.
I think things are that rich.
That's the richness that I don't feel like I'm going on a limb to say it's rich right now. But
where else are you going to go?
Tina.
The 10-year is touching 1 or approaching. I think it was 108. Where are you going to put your money?
That was the same thing everyone told me in 2004.
Sorry,
I get it.
I got to buy a house now, otherwise you'll never be able to buy it. There is no alternative to this. You have to buy a house now.
Look, I get it. I'm just saying, I think that the desire to push people out on the risk spectrum has been an effective policy decision. And
the Fed loves to take people up the risk curve.
Oh, it's the best, right? And I think it's hard to argue they haven't done
it. I put out a little tweet this morning, and I was just because I was annoyed about this rate cut, but I said something to the lines of like, elderly people are the most susceptible to this coronavirus, and yet also elderly people who can't get any yield now because the Fed is lowering the rates, and also, by the way, like pushing them out on a risk curve. Oh, and but playing with the potential of like lighting this whole thing on fire in an inflation and killing them from a fixed income standpoint. It's like who are we helping or hurting here? Like, what's the goal?
I'm not saying that's a false equivalency, but there was another one too, which is like if you think that the Fed shouldn't intervene, you probably also think that the CDC shouldn't intervene.
Mm.
Yeah, that feels a little bit stretchy
it's
to
a stretch,
me.
yeah.
Yeah, that feels stretchy.
All right, guys.
It'd be nice if we could get some like coordinated fiscal policy that actually made some sense. Like, I don't know, say an infrastructure bill. But right now it seems like people wouldn't go outside to build a road. I mean, maybe that's an overstatement, but that is how some of the sentiment around this coronavirus thing feels. Like, if you advocate going into public, you're endangering the species. I'm not there. I don't want people to die. That's not who I am. I just don't want us to shut down out of fear.
That's fair.
That's a cheery thought to end the whole thing on. I think that's an uplifting note.
No mailbag. We'll get money next week.
It'll be interesting to see what happens in the time between when we recorded this and when it comes out, because I feel like history's kind of moving a little faster right now than it has recently.
Yeah.
Well, watch this bottom. I hope it is. That'd be awesome.
We're having
this thing goes away.
Sometimes nothing happens in decades, and then decades happen in days. That's what we're in, that kind of environment now.
Yeah.
But that's all we got time for. Not a big mailbag this week. See you all next week.
See you next week.
Move with the rhythm. Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause